is us today. Okay, thanks, Juan. So let's get going. What is slippage and why does it happen, and what can you do about it? But before we can get into that, answering that question, we have to go take a step back and remember where the market price comes from, because that's actually what explains slippage. The market price is the level at which supply and demand meet, and as you can see there, that all gets orchestrated via different levels of interest with volume at different prices on the bid and on the ask side. And as you can see, as we go down in terms of volume, both diverge further and further. So you can see the spread widening more and more as we want to trade more volume. And that basically means that there's not one market price, but there's one market price per volume, meaning that if we trade more volume than is available at the top of the book, then we're very likely to get slipped in the order book, so kind of slide down the order book and therefore get a worse price. And that really is the definition of slippage, the difference between the price at which you wished to trade and the price at which you actually get filled. So it really comes about because of two underlying factors. The first one is a technical one. It's latency, and it has to do with the fact that by the time you see a price on your terminal and you choose to act on it, that price is already history. The price you see now is the price at which the global interbank currency market was trading X milliseconds ago, before the information traveled through to you via the internet. And of course, as we shall see in a second, for instance, if you go back to say live feed, as you see here, this price moves all the time. So it keeps moving even in a limited. Like right now, we're not even seeing the tick level changes yet. It's just like a stream that comes and updates kind of a couple of times a second. But as you can see, it's moving all the time as we go along. So whatever latency implies that because the price is moving all the time and the news takes a while to get to you, it will have changed by the time you see it. And that's one of the reasons why you could close at a price different from what you saw, because of course your trade has to travel back to the market, and again it will have moved on the way back there. So which basically adds up. So there's the news was old by the time you saw it, and it will have further, the market will further move until you hit it. So you've got twice the latency as a time that could move the market. And second, but last but not least, as I mentioned, liquidity. A lot of people assume that because we're talking about the foreign exchange market and that's the most liquid in the world, that it's actually infinitely liquid, and that's actually not the case. If it was infinitely liquid, then you could make infinite profits by just leveraging yourself to the infinite and beyond, and that's just not the case. So the more you move down the order book, the worse the price you get. So is the point on latency clear? Do I have to go more into it? I guess it depends on where you are in the world and how good your internet connection is. There's a number of so-called pings, nodes in the internet that an internet information say that the price feed has to bounce until it gets to the node to which you're connected from your home. And the more at every node, a bit of time is lost. So depending on the number of nodes and the quality of the infrastructure between you and the other, the latency will be bigger, and therefore the potential for slippage is bigger. On the liquidity bit, as I mentioned before, so just taking here a snapshot again, you can see that the volume weighted average price on the ask and on the bid moves apart as we go down into further volumes, so much so that you could see you could be seeing a spread at top of hook on 0.3 on say the euro dollar. But then if you're trading a 10 million 100 lot trade, then the actual spread you'd experience will be 0.6 on a weighted basis. And because if you're trading the 10 million, then it could be that it's already 1 pip off the top of book at the marginal level. So that's the other reason why slippage actually occurs. and that's just like the law of gravity in financial markets. The more volume you want to trade, the worse the price, and therefore the slippage. And that's what makes it impossible to make infinite profits from any given strategy, and what makes scalability such an important factor. So, and this, I mean, I've seen the list of attendees. You guys are all very experienced guys in the market, so probably at the risk of repeating too much. But basically, one of the things to drive home, and I'll do this for the recording, is that slippage is structural to being in the market. So if you are in the real market, you are bound to experience slippage. You can't avoid it. There's no way around it. So, and that's when the question comes. So, why did do some brokers not have any slippage? How is that possible? How does that work? Well, the answer is one of three. It could be your account is very small, so you haven't really experienced the effect of slippage when you trade because you're barely moving anything. It could be, and this is the most likely reason, you're not actually in the market, in the real market. You're actually trading against your so-called broker, who's a dealer making markets against you, who therefore can single-handedly control the market price because they are the ones that make it. And for sure, you will only experience non-slippage conditions forever if you're not winning. And let me explain why. So, to come back to the slippage question. So what we've got here from left to right is a time lapse. So you'll see a certain bid ask on your screen at a certain point when you choose to trade, and when you click your button on the way down, there's the latency that will have elapsed from the point that this price left the broker, and then your order going back to the broker. The market price will have moved. The spread will be elsewhere, and that only leaves two possibilities. The first one is that the market price has moved in your favor, and by closing at this price, you will have a loss that's undisclosed to you. So you will basically missing out on a better price. The market had moved in your favor, and by filling you at the old price, then your dealer has pocketed an immediate profit. Or it could be the price has moved against you, meaning you ought to be filled at a worse price than you requested, and then it's really a choice by your dealer. So, do I actually take this hit or not? And the most likely answer is, if this is a customer that over time tends to have to do this as often, tends to win as often as they tend to lose, it's okay to accept it, because of course there'll be other situations where the things will go in the favor of the dealer. Or if more likely, if we're talking about a scalper who's exploiting the arbitrage opportunities that this manipulation of the offered price offers, then they will notice that it tends to be the case that the scalper always tends to be on the right side of the trade. And in that situation, two things could happen. One is they choose to requote you, so that basically they offer you to trade at the worst price or not trade at all. That would be one option. Or the other option would be to say, okay, then they put you, instead of on the B booking feed where they're making the markets, they put you on the A booking feed where they're sending you to the actual STP market, in which case you will start to experience slippage. So, but the point is, there's no way to trade in the long run and win without slippage. At some point, you're going to get sizable enough, or you're going to get noticed enough, so that nobody will choose to protect you from it. That's really the reality of the whole thing. So you're probably asking yourself, so how can I avoid slippage? Well, there is a way, and that is by making or providing liquidity. So the way liquidity providers operate is by pricing limit orders, so which include two parameters. One that define the volume, so 10 lots, and the price. So I would offer to trade 10 lots in the euro dollar at a certain price as a maker. As a taker, all you can do is basically ask to secure the filling of the trade. So I'll take, sorry, there's a bit of Spanish left over here. I want to trade 10 lots in the euro dollar at the best market price prevailing. But importantly, you secure either the price or the execution, but you can't secure both. So in this case, for sure, the maker, the liquidity provider, will get filled if they get filled at 1.09737, but they may not get filled. So the 10 lots are not guaranteed. The price is guaranteed as a maker, but the fill isn't. As a taker, the fill is mostly guaranteed, but then you have to give away control of the price. There's no such thing as being able to control the fill and the price, because that would basically mean you can dictate your own price and dictate your own profits, and that's just not how it works. Okay, that would not be the market. That would be some sort of fantasy land. Is that understood? Any points there? Oh, good. Okay, so basically that's how it all works. And now, why all this? This is not just some rhetorical question. This is going back to a practical issue to do with MT4, and that's the way that limit orders, say stop losses and take profits, work on MT4. And this is a frequent source of disputes with customers who blame us for stuff who don't really know what's going on. And this is the issue. So when you set up, say, a stop loss on your MT4 terminal, what happens then is that stop loss is stored on MT4 server and only triggered when the price, the market price being fed by the bridge into the MT4 actually touches that level. And at that point, what MT4 does is send a market order to the market for that trade to be filled at market, meaning it is not guaranteed that the price will be the price at which you set the stop loss level, but rather it will be at the prevailing market price. Now, considering those tend to happen at times when there's sudden jumps in the spread because of thin liquidity, then weird stuff can happen, and we have stuff like this. I would say every week, but it has happened, say, once or twice a month, in situations where people go into, say, news events or market rollover with tight stop loss or take profits, and then say the take profit gets triggered at a time when there's little liquidity, and the trade is then filled below the stop loss, which would indicate that we're sort of a bunch of bucket shop trying to manipulate the prices, but really that's not what's going on. What's going on is that MT4 doesn't allow you to create limit orders. So long story short, you can't avoid slippage on a direct market access broker like us. This is something just, you have to live with it. Either you choose to be in the real market, or you choose to go with a dealer who protects you against it, but you can't have it both ways. Okay. So that's one of the situations. So limit orders on MT4 are not strictly limit orders, so you can't secure a level of closing. What you can secure is the execution, but they may be at a price that's slipped against what it was going to be. Another classic one is, I bought this fantastic EA and it doesn't win as much as the advertiser mentions. And the reason for that is that every time you're hitting the market, you're hitting it at a worse price than what the EA offerer was offering. And that's because there's like 55 people with 75, or 550 people with 75 brokers and more that are sending the same trade at the same time to one and the same market, which is the Forex market, and the orders are big enough, then they will trigger these protection mechanisms with the LPs, who basically withdraw from the market if they see they're being hit from one side too much, to just avoid being caught on the wrong side of trades. And what that means then is that there is a horrific slippage in some of these most popular EAs. And again, if you may face a situation that you don't have slippage, but that could be because you're trading with a dealer who knows fully well that no one in his right mind sells a long-term winning strategy as an EA. So I guess that comes back to the same thing. So if you buy a very popular EA on a true direct market access broker, you're likely to experience slippage if that EA is popular. Now, you're probably also wondering, so how does it work with Darwin investors? Well, of course, they also experience slippage because they go with large volumes, and that's why we have recently introduced a bunch of functions to track this at the Darwin X interface. We wrote a blog post on these recently, but I'm just going to explain that for you guys. This is the wrong site. And again, this would be the one. So let's just go for JMC, because this is a good one to explain the phenomenon. By the way, I hope you guys noticed that we're also now disclosing the capital invested in the Darwins, as we shall see in a second once this brings me back. So we've made that step to get there. And there's a bug, by the way, which you're trying to fix, which you just saw. So if you're logged out and you're trying to go to the Darwin page, a detailed page, and you log back in, it'll take you to dashboard instead of to the Darwin the way it used to do. So we're on it and we're trying to fix it now. But coming back to the subject, so you see, for instance, that this Darwin has a negative monthly divergence. So you're probably asking yourself, so what's that? Well, divergence is the fact that Darwin investors experience systematically in this case, negative return compared to what the original Darwin was experiencing. And this is something we now track. And we are now much, much closer on some of these Darwins to start implementing the Darwin closure process, which works as follows. Whenever the monthly divergence hits a threshold of -1% per month, which this one is not all that far from, then what the system will do will be to close the Darwin for new investment, meaning you'll be able to sell out of it, but you will not be able to buy into it until the divergence figure gets better. And this is basically the point. And I know our friend Vlad here is listening, for instance. So we know that many of the highly scored strategies that are making good profits are actually not very scalable. And basically, this will be the point when they hit the roof. So this one has, like, say, $200,000 of investment here, and it looks as though it will not be able to handle much more than, say, 300 to 400,000 euros. At some point, we'll have to shut it down. On a related note, another reason for slippage is the fact that some people are choosing, and it's of course their good right, to have dual listings for the Darwin. So they might be offering MAM accounts on their algorithms, and also publishing the EA commercially, and then also listing the EA as a Darwin. But this is the point where you can't have it both ways. So if you want to charge a success fee, you will only be able to charge a success fee as long as your investors are still making similar return to you. If there's too much divergence, then I guess you'll have to choose on whether to publish at Darwin X or continue to sell other alternative channels. Obviously, the choice is down to the user, not to us. All we do is inform the investors of what's going on. There's also so this is the tab we showed here, and then there's an even more relevant tab, which is the tab for where you see the divergence in action with its two components. So one being the latency measured from the point where we DarwinX receive the fixed drop copy confirmation that the Darwin provided trade has cleared until all the volume by investors clears behind that. So, for instance, what this is saying is that this was a trade for 2.3 lots done in the in pound Aussie dollar, 250 milliseconds, or like a quarter of a second after the Darwin provided trade cleared. It had a positive slippage or divergence, that's why it's green. But then there were others which were not so green. In fact, they were pretty red because they were slipped by 1 pip or more. And this will, of course, depend on the times at which the Darwin provider chooses to trade. I hope you guys knew this functionality. So it's now standard for all Darwins, and of course, what this opens the way for, paves the way for, is how to maximize the scalability by the different Darwins, and that's something we'll start devoting resources to. So obviously, it's both in our interest and in the Darwin provider's interest and in investors' interest that we manage to get as much volume as possible onto the good Darwins, and this is when algorithms like the ones that help us break up the execution into smaller fractional trades to essentially see that we minimize the disruption to the market price and therefore allow more investors in. So that's something that's coming. So that's that. Any questions on how the Darwin divergence process and slippage all work with each other? Okay, looks like we're good. Right. So, and then I'm just going to give you a sneak preview to an all new section that will go live on if things go well, Monday or Tuesday next week. So you're looking at the pre-production environment. Of course, I've been kicked out now. Let's see if it works. Yes. So we've got now the detailed page, and you see there's a new tab here. So there's the basic investment attributes trading journal, and then there's a one which is called execution quality. And what we'll do here is disclose all the execution details for both open and close leg for all trades in your accounts, including execution time and slippage and so on and so forth, so that you can check at all times how it is that we're clearing your trades. Initially, we're not adding that. We haven't managed to deploy a chart on this first version. It is planned to show two charts, one displaying the distribution of closing time, so in milliseconds, plotting how many milliseconds it takes on average for a trade to close, and including the full distribution. And the other one will be the distribution of slippage, so that hopefully everybody can see that with us, yes, we're a DMA broker and you do get slippage, but then slippage is not necessarily always against you, but rather random, just a random fluctuation that evens out over time if you trade for long enough. So this is another push to try and introduce as much transparency as we can, and show traders how it all works. So I'm just going to see. I don't know if there are any questions, because this is really what was the body of today's slippage webinar, which we'll disclose for what we'll put up on the YouTube channel for everybody to listen to. So I have a question by one. This is personal or for investors to view? I think so. This bit is personal to you, so only you will see on your own thing, because this affects the execution of your own account. The other bit, this one, is not personal. This will be public for all Darwins, because this is a very important decision and I think a pretty important information point for you to decide on whether to join a Darwin or not. So you should know, and this is where we tell you that if you see a red line, this is red, and by the way, it could be green for others. If this is red, then you're bound to not have the same returns as the Darwin. So we don't want to mislead you, and this is what we tell you that's going on. So to answer your question, this bit is private to you. This is like we only disclose to the actual Darwin provider, well, actually to the customer, because this is not to do with you. You will also have this section even if you're not listing a Darwin, and this other section will be public for any potential investors to see. Hope that answered the question one. So if not, let me know. Yeah, and really that's all I had when it comes to the slippage question. So guys, feel free to ask any more questions if there's anything outstanding. I should also mention that we've made a bunch of strategic decisions this week that we'll communicate in due course. But you should know that we're going to add features to our offering in the next months. There's also a completely revamped version of the investor interface on its way, which we hope you'll like. It'll still be several months in the making, but it's now fully designed, and it's one of the sexiest things I've seen when it comes to financial investing. So I'm very keen to ship it out to you guys and get your feedback. But although yeah, that will still take some time. And now on to the big elephant in the room. I'm sure you guys are wondering what goes on with Brexit and the fact that we're FCA regulated, and when will margin be back to normal. So let's start with the margin back to normal thing. We're not the ones to dictate. So obviously we offer the margin that we get from our prime brokers. We think it would be foolish to offer additional, like to lower the margin requirements against what the prime brokers give us. And the fact is, there's quite a bit of volatility right now in the market. So everybody's still kind of wondering what to do after the Brexit thing. I suspect we're going to stay with high volatility, although possibly not crazy volatility, in the next weeks and possibly months. and we will follow in our prime broker's footsteps in lowering margins. But I think the prudent thing to do is not to let people go wild, because we want to be around for the next crisis. So the answer is, I don't know one. It doesn't really entirely depend on us. I suspect the margins will remain higher than they were for the next couple of weeks until things slowly return back to normal. So somebody is asking if you can block the leverage like the other brokers. So sure you can. I mean, you can set the leverage below what below the maximum. So that's a personal choice for you to be making, and you can even do it on when you kind of define the account size. So I think that's something that's possible. We're never going to force you to trade with more leverage than you want, for sure. Okay, so okay, there's that. And then the other question is, of course, around regulation. Obviously, um, it's still very, very, very early days in terms of what will happen after the Brexit thing. I don't think anyone really honestly expected that this bloody referendum could go so pear-shaped, but in fact it has gone so pear-shaped. So I guess we're in for a bit of a ride in the next few months. I strongly suspect that what will happen on the financial side of things is that everybody strives to, obviously the European Union and the UK are done for the foreseeable future. But that's not to say that, say, the UK will leave the European Economic Area, and that's actually good news, because if you check, and this we can do, so you can see that the passports that we have as an institution reach out to, say, a country like Norway. And Norway is a country that is not in the EU, but is in the European Economic Area. So what I suspect will happen is that MIFID will continue to apply, and it will continue to be possible to cross passport out from the FCA regulation, which will probably stay a respected regulation, onto other European countries. Obviously, this is just my hunch. I could just be wrong. But yes, so there's a bit of political drama talk, as one is saying, and I certainly buy into that a bit. Although I still think it's a major blunder for both the UK and the EU to have done things this way. But time will tell. Certainly, I could have gotten more sleep tonight than I did if bloody David Cameron hadn't called the referendum. But that's another story. The question is, I think, so Vlad is asking if Switzerland is not in this group. Switzerland is not in the European Economic Area. I think it has a preferential agreement, but it is not in the European Economic Area, because they have certain, basically, I've actually lived in Switzerland, and they have a lot of small protectionist measures to make sure that the Swiss can export to the EU, but the EU has a harder time exporting into Switzerland. And I guess the condition was to go without the EEA thing. But I guess I'm just a poor guy trying to run a startup. And Vlad is asking, is Darbonex authorized in Switzerland? And the answer is no. We're not authorized in Switzerland per se, but I think it's okay for Swiss nationals to deposit with EU regulated entities. That's okay. So one is asking me if we're not in Instagram. So yeah, I'm getting old, man. I'm 40 and I'm not part of all these different social networks. But I have a word with the guys who run that and see if we can do something about it. So Christoph is saying that he had slippage of 39 pips. I know that slippage is possible, but is it too much? Again, I mean, it doesn't please me when there's slippage of 39 pips, but one thing we will do is to prove that for every instance, there's basically one instance of positive slippage of 39 pips for every instance of 39 negative pips of slippage. So it's basically, remember, you're trading our account, and whenever you get slipped, it's because we got slipped. And I appreciate it doesn't please you, but neither does it please us that you have slippage. We do everything we can to avoid it. But the fact is, we tried we trade with counterparties that are true DMA counterparties that are solid in the market, and they are at times not, well, they don't manipulate the market price, they don't narrow it down, and that sometimes results in bad examples of slippage. So I'm sorry about the 39 pips of slippage, but beyond saying that you're as likely to have it negative as positive, I can't really say much more. Sorry about that, Christoph. I mean, if you think that something's been done, send us the details of the trade and we'll try and question the LPs on that. Yeah, well, that's pretty much it. I mean, the spreads have been pretty crazy today. That's for sure, and they may well be remain crazy going forward. It's not good for anyone that they are, but I can't just make up the market price. We source it from the real market. So Christoph is asking, is a fixed spread impossible? And the answer is yes, it is impossible to have a fixed spread if you are a broker. Of course, we could be, there are dealers out there who offer fixed spread because they basically create the market price by taking risk against you. But you can't have it both ways. If you want to trade against the open market, you have to live with variable spreads. Yeah, and I guess what we've seen, and that's the other piece of advice I've seen. Like most of our good traders have done well to stay away from the market this week because there was just too much to be lost and too little to be won. Then a couple of guys played the lottery, and we've had both examples. A couple of guys who blew their accounts, and then a bit of our money. Luckily, not much because we had raised the margin so much. And then there's been a couple of other guys who've hit the jackpot and made a ton of money by being on the right side of the trade. That's what happens with every lottery. Okay, so it looks like there's not that many more questions. So if I can help with anything to do with slippage, I will do so. As I said, we're trying to basically be as transparent as possible and disclosing all the execution of all your trades, so you can see that yes, there are times when the slippage is negative, but also you should not forget that there are times when the slippage is positive, and then you're not getting angry or grateful at us when that happens, because that's just how the market works. Okay, well, as I said, thank you so much again for being with us. I think we've now survived two of these, so we made it past the Swiss franc thing, and now we've made it past the pound thing. Obviously, we have learned a number of lessons to do with the risk management algorithms, and those are not lost on us. So lesson survived, which is all we can say. It's not a pleasant time for anybody, but we're still around. So somebody's got a question about gold. Do you mean margin on gold? Pure pip producer, is that? Yeah, no, gold is open for trading. It's increased margin, so lower leverage. But yeah, for sure you can trade gold. You can find it on the MT4, and you can trade gold as much as you want. All right, guys. So always a pleasure. Take care. If you have any ideas for upcoming webinars, do let us know. And I look forward to more and future interactions. It's always great to be with you guys and receive the feedback. So take care, and wish you all a great weekend. Bye bye.